That's the shocking part of it, the investors said. JP Morgan is one of the most sophisticated lenders in the world. How the hell could they have missed this? Thursday, September 25th, 2025, Maneco 64, home of alternative economics and contrarian views. Well, we're going to look at the debt market today, the banking and financial system. Yes, I'm not an expert in banking and the intricacies of the credit system, but I can see that there's some problem, and even the FT is reporting. So we're going to look at the asset-backed securities market, and in particular, we're also going to look at the subprime auto loans market. I'm not sure how old you are, if you were an adult during the Great Financial Crisis, but there's a very memorable comment from Ben Bernanke, and I think it was back in late 2007 when the subprime mortgage crisis had kicked off. He came out, I think, on CNBC, and he said the economy is doing well, there won't be a recession, and he said the subprime mortgage market is contained, the crisis is contained. We all know what happened after that, right?
He went on to talk about the subprime market. Another fear yesterday was that there'd be contagion, but not in the eyes of Ben Bernanke.
Our assessment is that there's not much indication at this point that subprime mortgage issues have spread into the broader mortgage market, which still seems to be healthy, and the lending side of that still seems to be healthy.
So I think it's really important to look at this because it's a big market. We got to look at the numbers. Subprime auto loans, yes. And there's other kinds of credit like credit card debt, but we're not going to touch upon that. We will, though, touch upon that very soon. I'm going to have the Timeless Investor. That's a relatively new YouTube channel, and he's a financial historian, and I've had him on the channel, and he recently spoke about the 1866 banking collapse in London, Overend, Gurney and Company. Not many people have heard of it. But during the day, during that time, it was almost like when Lehman collapsed in 2008. And I highly recommend you watch the video he made a couple of days ago. I'm going to put it up here in the card. It's a great video. I'm going to have him on soon to talk not just about his video, but about what's going on in this ABS market and other credit markets. And one thing, the Timeless Investor, his name is Ari Van Gemeren, said is these things happen all the time. Just because that banking crisis happened in 1866 doesn't mean it's not gonna happen again, because we're in 2025. Basically, yes, human nature never changes, right? There's the old French saying, le plus ça change, le plus ça devient la même chose, or the more things change, the more they become the same. So enough of that. Let's look at the article that came out yesterday. Yeah, and I'm not surprised because I think I've spoken about Tricolor, which is a subprime auto loan company that's just failed overnight. And that's the thing about these credit crises, banking crises. They don't happen gradually, right? They happen suddenly. And in the case of Overend Gurney and Company, and also Silicon Valley SVB back in 2023, in 12 hours, those two had collapsed. Yes, 12 hours. And that's why it's so contagious and so dangerous. So, U.S. debt investors raise alarm over lending standards. Concerns come after unraveling of two companies deemed just weeks ago to be in strong health. Just gonna take a little sip of my coffee. Yes, it's one of the mugs in our merchandise store. If you're interested in the merchandise, there's a link below in the description. Anyway, U.S. debt investors have raised the alarm over lax lending standards in credit markets after the unraveling of two companies that just weeks ago, were deemed to be in strong health. The failure of subprime auto lender Tricolor Holdings at the start of this month, followed by the exploration of bankruptcy proceedings by car parts supplier First Brands Group, have wrong-footed investors. Tricolor had won pristine AAA ratings as it borrowed in credit markets. Sound familiar, right? The subprime mortgages back in the day, they were all AAA. While First Brands may have amassed as much as $10 billion in debt and off-balance sheet financing, and was close to raising even more last month, investors were ready to dismiss each as one-off incidents, but taken together, the two offer signs of cracks within credit markets, which have become a critical source of funding for consumers and businesses as traditional banks have retreated since the financial crisis. Yeah, this kind of financing is called the shadow banking. And shadow banking, the reason it's called shadow is because it's not regulated like a normal bank. More dangerous, less transparency, I would say. Traders and investors told the Financial Times that they have raised questions about the controls in place that would have allowed Tricolor and First Brands to reach the brink so quickly. One investor who sold out of Tricolor debt last week said the collapse of the company and ensuing market turmoil was one of the worst things I've ever seen in the asset-backed securities market. Maybe he wasn't around during the subprime mortgage meltdown in 07, 08, 09. Anyway, both companies made use of asset-backed debt, with Tricolor building up subprime car loans into bonds and First Brands tapping specialist funds to provide credit against its invoices. At its core, asset-backed finance is the ability to lend against specific asset or loan, including consumer credit card balances, leases on rail cars and solar panels, aircrafts, and music royalties. Some investors said they had recently combed through their portfolios to confirm that other companies they had lent to did not face similar troubles, and were now asking more detailed questions before underwriting new deals. U.S. investment firms have, in recent years, pushed deeper into asset-backed debt, often pitching it as a safer product than the loans to junk-rated companies that are their bread and butter. But Tricolor is now being probed over fraud allegations by the U.S. Department of Justice. While some investors have long had questions about First Brands' financial reporting and use of invoice factoring, with lenders now concerned that they have lacked visibility about the scale of off-balance sheet financing. First Brands declined to comment for this article, while Tricolor did not respond to a request for comment. Fear over the unraveling of Tricolor and First Brands threatens to take the shine off one of the hottest corners of finance. Asset-backed credit is not a new product, but it is rapidly evolving as titans on Wall Street, such as Apollo Global Management and KKR, devise new ways to lend. Yeah, they're the people who will create these private equity funds, and they want the small investors to get involved now. So be careful. Caveat emptor. The development had been a boon for non-bank lenders such as Tricolor, which used demand for car loan backed bonds to turbocharge its lending. Lenders had provided roughly $2 billion against portfolios of auto loans originated by Tricolor are now in a difficult position. The company missed a September interest payment. Two people briefed on the matters said, and some lenders are repeatedly attempting to seize vehicles, not homes, cars now. Several large banks have also been caught in the collapse. And I think this is why no bank is really safe. Yes, I have a bank account, but I try to keep as little as possible in there. And it says, including JP Morgan Chase, Fifth Third, which are exposed to losses on hundreds of millions of dollars worth of auto loans. A second investor who has since sold their position in packaged up Tricolor loans said they had no idea how potential financial irregularities went unnoticed by JP Morgan Chase, one of the banks that underwrote debt offerings. That's shocking. That's the shocking part of it, the investor said. JP Morgan is one of the most sophisticated lenders in the world. How the hell could they have missed this? JP Morgan declined to comment. Well, there you go. It continues. Global policymakers have sought to strengthen the banking system since the financial crisis, in part by shifting borrowing away from regulated banks into other parts of the financial system. Officials at the European Central Bank were briefed last week on the rise of non-bank lenders such as Tricolor, as well as the company's demise. So this is not me here trying to scaremonger the public. Even the ECB is concerned. Thomas Piskorski, a professor at Columbia University's business school, said Tricolor's failure could prompt investors to be more cautious. Yeah, that's not surprising. Rating agencies will scrutinize deals more, which means the availability of credit may be somewhat reduced, he said. So I'm going to stop right here. You get the idea of what's going on, and now we're going to go through the size of the ABS market, or asset-backed securities market. And I did a little bit of research. So according to ChatGPT, the market is worth about $2.5 trillion or $2.4 trillion. But they also talk about the fact that it could be worth 13 trillion if you add assets like mortgage-backed mortgages, collateralized debt obligations, etc. So we don't even know how big it is, but it's in the multiple trillions, the asset-backed security market. As for auto loans, well, that's around 1.5 to 1.6 trillion. That's the size of outstanding auto loan debt. And according to ChatGPT, it's growing at around just under 700 billion a year. So it's no small change. And the thing with credit crises, bank runs, is that it comes out of left field. I'd never heard of Tricolor or auto brands until now. Well, I heard of Tricolor when it failed in the beginning of the month, but before that, I never heard of it. And it usually starts like that with very unknown companies, and then it spreads like wildfire. And I think we need to be really careful and aware of that. It could be a matter of hours, until the whole system is under threat. And that's why I think it's important for you to listen to the Timeless Investors video on that banking collapse in 1866 in the city of London. And I'll be interviewing him soon, and hopefully we'll post that sometime early next week. And it's 7:33 a.m. London time. Yeah, gold had a bit of a correction yesterday. I guess things can't keep going up in a straight line, is the old saying. Yeah, you're going to get corrections. I think one of the reasons why we saw it come off quite sharply, I think we got down to 37.17, the spot price, is that we have the COMEX October options expiry today, and a lot of the options market makers, they sell a lot of the calls, like investors and small speculators. They usually go long gold calls or silver calls like I did. And what they're trying to do is they're trying to keep the market from going above some of the calls that they sold, maybe the 3,800 call and so on, because they'd lose a lot of money. So I think gold and silver, well, silver held relatively well yesterday compared to gold, but we could still see a little bit of pressure today in gold and silver. But I think things are still, I don't think anything's changed, especially with what's going on out there in the credit and the banking system that is really concerning, is so concerning that the ECB is looking at it, and I'm sure the Fed is keeping a close eye. But anyway, gold right now is at 37.45. It's up about $9. So the high's been 51 and the low 29. Silver is trading right around 44. It's up 10 cents. The high's been 44.03, the low 43.76. And I noticed yesterday that Treasury yields, at the longer end, they rose a little bit. Nothing major. We'll keep an eye on it. And with that, I'm going to wish you all a very good day. Take care. Bye.